Hey everybody, Preston Bryn here. Welcome to this free edition of our Trader User Group. This is for the trading week ending June 5, 2020. As I said, I'm Preston Bryn. Thanks for tuning in. This week's theme, running with the bulls. And as always, our motto is don't be a rat brain trader, be the red striped zebra. Stand out, folks. So let's take a look at kind of what's coming up this week and what's happened and where we are with price action. So what I want to do is just kind of go through a couple of weekly sound bites for you. But first, let's take a look at the index performance. If you look at this, you can see in the US markets, all of them had a very strong week. The Dow, the S&P, NASDAQ, the Russell. The Russell was the strongest, up 8.11% for the week. You can see year to date, in the green is NASDAQ at 9.38%, and the others are in the red, but not nearly as much as they were a few months ago. We've had the strongest 2-month run in decades, literally decades, okay? So you can see we've got very strong performance coming up. Now, if we look at the sector performance for this past week, you can see here that the best sector was energy. Just energy is also having one of the best months in history. Especially the oil markets. Energy's up over almost 16% for the week. The worst performing sector was almost flat, finishing just negative 2 basis points. Healthcare. But basically just a very, very strong week. And of course, if we look across the planet and just kind of see what's coming up across Europe, the FTSE CAC 40 DAX all up double digits for the week, just huge bounces. And if we look at the Asian markets, you can also see the Nikkei, China, Hang Seng, the Hong Kong Index, all of them up. So all in all, this week was a very, very strong week. And then of course, if we look at valuations and see how that finished out the week, you can see the trailing 12-month PE ratio for the S&P finished at a whopping 27.17. The forward 12-month ratio, forward guidance, 24.37. That's lower than the trailing, but still very high. A lot of analysts consider that too high. The dividend yield for the S&P right around 2%. 10-year Treasury about 90 basis points. So we still got a pretty wide spread that, for big money going into the equity markets, they're going to get an additional 1.1%, let alone the climb in the markets based on what we're seeing here. So just all in all, just a really strong week. Now, if we just kind of take a look at some weekly sound bites here, just kind of see, where the markets, how the markets fared. There is a disconnect with the markets and economic data. And I've always said that you should expect that. The markets are not the economy and the economy is not the markets, but it's grown deeper. We're seeing this ongoing fight between the bulls and the bears, right? And the market scoring this past week, as I showed you, a lot of double-digit gains globally, the best weekly gains in 2 months. Now, we were led by small cap. The Russell, as I said, the Russell, if a reminder, was up over 8% for the week, okay? Now, we're seeing some of these upside surprises this week in economic data. We got it in the jobs numbers on Friday, which just really blew away all analysts' expectations. Analysts were expecting 9 million jobs lost for the month of May, and we actually hired 2.5 million. In fact, I was watching across several different business channels, and they were confused at first, thinking it was down 2.5 million, and then they had to look again to say, oh, wait a minute, my gosh, it was up 2.5 million. Markets took off. Also this week, in the middle of the week, we saw that ISM numbers and construction spending came in better than expected. Granted, the numbers were still down, but a lot better than expectations. As you guys know, it's always about expectations. Some traders, I get the impression, are trying to look for this all-purpose trade. And I saw it is kind of best described in Barron's. Gee, I'm looking for a trade that can be long and short. It can be bull and bear. It incorporates fear and greed, kind of like an option straddle that'll play any direction from volatility expansion to contraction, and it prices the rips and the dips. Kind of like what was buy the dips and sell the rips mentality now seems to be buy the dips and buy the rips. Just kind of a FOMO kind of thing, the fear of missing out, all that kind of fun stuff. So it's keeping bulls active while the shorts are being squeezed around the throat. This self-imposed price action is kind of like the markets are giving traders a huge wedgie. Now, in our user group, we've got some trade strategies that we use that are just really keeping us in the markets and allow us to make really good money, but it also makes money in the down markets as well. And it works well whether you're day trading, swing trading, or position trading. We call it our Morpheus system. For those of you that aren't in our group, I highly encourage you to come in and check us out. We're doing really well. We've got a lot of guys that are just really knocking the ball out of the park, both upside and downside, right? We don't really care where price action goes as long as it's moving. We can do fairly well in this. Now, as I mentioned earlier, the PE ratio, if we take a look at the earnings, forecast are about $126 this year of total earnings. That would put the PE ratio at the end of the year at the current price of around 31.93, call it 3,200. It put the current PE ratio at around 25.34. Okay, now as you guys remember, I said the current PE, the forward 12-month PE is at 24.37. All right, so that kind of keeps us steady as she goes right around where we are right here. Keep in mind, 2019 finished the year with earnings of $162 for the S&P. But estimates are showing the S&P next year could shoot back up and we can have earnings over $1.80 for the year. And that would put, even at current price levels, the PE around 18. Okay. Now, I want to remind everybody too that the Feds have spent in fiscals or in monetary stimulus close to 40% of the US GDP. And top on that, Congress could add another 30, possibly 35% of stimulus. That would be like 75% of the total GDP, juiced by the US government, really, until the US economy is self-sustaining. So there is a little bit of a artificial market with all this stimulus floating, kind of just where it's going right now. I mean, just really huge. And of course, if we bounce over to the credit markets, right, and we take a look at that, the 10-year benchmark treasury, climbed to its highest level since mid-March. Okay. We're also seeing bond prices and yields moving opposite direction. Remember, as a reminder though, bond prices and yields move in opposite directions. So we're seeing bonds come down as yields go up. So it's resulting in a little bit of a sell-off in bond market. But that's kind of supported by better economic data. And as most of our members know, I've been telling everybody that if interest rates go up slowly and in a controlled fashion, that's a good thing for the economy. Okay. That, believe it or not, is a good thing. It's just when it gets out of whack and starts moving really quick is what happens. It causes agita in the U.S. economy. Meanwhile, I'm also seeing investment grade corporate bond market getting very steady. In fact, Amazon just issued a 10-year bond, corporate bond, for like 40 basis points. I mean, just amazing. So the money is out there. The yields are very tight because the Feds have jumped in and they're buying high yield junk debt. They're keeping liquidity around there. They're keeping spreads tighter. That also helps goose the financial markets because money is out there, easy to be had. So it can buy time for really good companies to wait till the earnings really take off. And to the downside, it can save a lot of companies that really should just fold and go under, but it keeps them active as well. Okay, so but net, it is a net positive for the U.S. markets here and all this stimulus. But speaking of stimulus, let's jump across the pond and look at the ECB. They came out giving buoyancy to their markets all across the 19 countries that make it up by coming out with a fiscal package of about 1.35 trillion in stimulus over there. I mean, just huge. And it's just amazing. And they're going to continue to reinvest in maturing bonds over there until the end of 2022. And they kept their interest rates unchanged as Queen Bee Lagarde came out with her statement, right, on how they're going to support the economy over there. And they're going to do what they need to do, just like the Feds here. So in many respects, the ECB caught up a lot with the Feds here in the U.S. with stimulus. So we've got money floating around all over. So that's really going to help support the market. It's kind of like this giant put underneath. Now, understand the ramifications of all this as this needs to be unwound is going to be a lot uglier. And sometimes the bond market is going to force it upon the central banks to react to it, but not right now. Probably not in 2021 either. But I am forecasting, as I told our members, in 2022, 2023 an ugliness in a bear market that we haven't seen since '08, '09, or the dot-com bubble, where it's just going to be ugly. But we're going to be ready for it, and we're going to make some great money in that move. All right. Again, if you're not a member of our group, I highly encourage you to come in. We're doing fairly well. And then finally, before we go take a look at the charts, US and China, right? Well, their tensions are simmering in the background. But this past week, in kind of an olive branch to China so that they can continue their phase one trade deal, the tough nut on the U.S. team, Robert Lighthizer, he came out Thursday and said he felt really good about the progress of this phase one agreement with China, right? He's saying so far they're honoring the pact and fulfilling its commitments on structural change. So that's a good thing, all right? Let's see how that thing really plays itself out, but hopefully it'll work out fairly well. So I'm going to stop my screen here for just let me just move things over here. So just bear with me 1 minute. What I'm going to do is I'm going to adjust and I'm going to come over and show you another screen here. So let me just get this over here like this. And let's just move over to, here we go here. I think it's screen number 5. I got 12 monitors on my desktop, so it's really just trying to control all of the screens that bounce around that you guys are seeing here. It's kind of like a Rubik's Cube following my cursor and where things are bouncing. So if you look at this chart, it's an E-mini S&P 500 futures, okay? And in looking at this chart, you can see here that I've kept it fairly clean. I've got now the yellow line is the 200 SMA and the red line is the 50 SMA, not EMA. And you can see on the right-hand side, I've got Fibonacci extensions off the lows of 2174 made on March 23rd and the highs that were made, all-time highs made on Feb 20 before we just, came unglued. And we cleared some very strong key points. The key point to me, at each one of these steps along the way, they've provided support and or resistance to us, okay? And then the key to me was the first key test was the 50 EMA or the SMA, right? The second key test was the 200 SMA. And once we cleared the 61.8% extension off these lows, just so that you guys know, and I've said this every weekly roundup for the past month, but I'll say it again for those of you that don't remember or are new to this update, is that going back like 70 years, every time we've done an extension off the lows over the 618 extension using the fib nodes, for every bear market, that means the lows have been made. Now, that doesn't mean we can't come back and test a little bit of a dip kind of thing, but that does signify, at least so far, we've never made new lows once we've extended this here. Once we've extended the 786, the odds dramatically favor coming back up and making new all-time highs, okay? Now, as crazy as that sounds, as odd as that sounds, given the current U.S. and global, for that matter, economic data, okay? I mean, right now our unemployment's about 13% or so, a little over 13%, which is higher than the worst unemployment we had in '08 and '09. Yet right now, we're literally only about a little over 1.5% less than our all-time highs. I mean, that's crazy, right? I mean, just really insane. So, but price action is divorced from current economic reality. We've got a lot of as I said, 40% of the GDP now is controlled by the US Fed, and another 35%, assuming they pass this second stimulus bill, of which Trump wants to add in infrastructure spending. You're looking at 70 to 75% of the GDP controlled by the US government, just enough to really kind of light the fuse to kind of get this thing going until the barn fire starts and then the economy starts to right size itself again. So that could move us up. Now, the other thing that's happening is as we move up in this channel up here, you're getting a lot of short squeeze around the throat It's giving everybody a financial wedgie. And the higher it goes, the more people want to jump into the trade because they fear they're missing out. You know, the FOMO, the fear of missing out kind of thing. And you still got TINA playing its role because interest rates are still very low. So you've got this, there is no alternative. So markets are forced to come in here and make this game. Now we're coming into the end of the quarter here, June. So you're going to see some rebalancing as we come into the end of June. You're going to see NASDAQ is going to do some, or the Russell is going to do a lot of rebalancing. That's going to add some upside. I would not be surprised to see us take out the 33.9750, which is the E-mini futures, S&P futures, all-time highs, right, before we pull back. Now, I am still saying that we're going to have a pullback of anywhere from 100 to about 250 points, but it's going to be a great buying opportunity for those that, you know, are afraid to jump in right here, okay? And the pullback is probably the first test is going to be testing this 200 SMA, which is sitting, by the way, right around the 3,000 level. Now we're well off the 3,000 level. We're at 3193. So it would be almost a 200 point pullback just to test the 200 SMA, right? It doesn't look like it, but that would be almost a 200 point move, about 180 points or so. And that puts us smack dab in the middle of this run right here. Now, I've got on my screen here, let me just get the drawings off here and kind of clear it up a little bit here. On the screen, I'm using eSignal. I can use a combination of Gann and Fibonacci to plot an Elliott wave 4. You can see these small numerical 4s here that show where a potential pullback would be. Or I could come in here and I've got a tool that'll just plot it for me from the bottom of the 2 up to the 3 right there, and it'll show a near term and a further term possible pullback, giving me an Elliott wave 4, which would then allow the Elliott wave to finish its cycle from a 3 here to a 4 here to a 5 here, or to a 4 here and a 5 up here, right? Like this on a daily chart. And that would take us up to our all-time highs on an Elliott wave 5 as we go through Q3, Q4, the end of the year, and then we go into this ABC chop, figuring out what we want to do in 2021. I think it's going to be a move higher and then a lot of chop, sideways action to down, and it's going to be a little bit harder to trade. For those of you that missed this action, I really encourage you to come into our group, because right around here, I was encouraging all our members. In fact, I came out with a list of about 8 to 10 stocks that everybody should pick up, even if you picked up 10 shares. I said, you know, and I didn't realize it would be this strong of a move up. I mean, no one knew, but I said in a year, you're going to be glad you bought these 10 stocks. Well, right now, a lot of them are doubles. Some of them are double and a half. But all good stocks, right? And they're still, most of them are paying dividends, with the exception of 1 or 2. So you can see here in this move up, you can see on this daily chart here, 29.64 and 27.63 are the center of these pullbacks for an Elliott wave 4. Now that's assuming we get a pullback in the near term. If we don't, the 3 leg is just going to continue up, and this is just going to move out in time, all right? So that's what it's looking like right here. If we look at this trade on the Ichimoku, right? And this is a 240-minute Ichimoku. You can see here, we've just blown through all of our levels here. And right up at this level here is where the, right up in this level, we've got a resistance level up here. But on a 240-minute, we're on a long extended Elliott wave 5. There is no divergence here. You can see we've got support underneath here. If I were to put it on a daily chart, it's going to look the same. It's just going to be extremely bullish, right, on this Ichimoku. And you can see here the bullish nature of this, where we just blew through the prior pivot point highs made in March, that first bull trap where it sucked people in because everybody was still in a buy the dip mode when we first had that big move lower. And then it just rolled right over. So we've already taken that out. That was a key level, folks, key level. So now you can see we got a wide support zone down here, which I would not be surprised that we're going to revisit sometime in the next 4 weeks or so. Just a little bit of a pullback. There is no divergence in the MACD, guys. There's none. And if we look at the accumulation distribution, you can just see there's money coming in here big time. And then the OBV, the on balance volume, it's moving up very strong. Okay. Look at the RSI. It's getting into an overbought situation on this daily chart. When we get in an overbought like this, the RSI right now is sitting at like 7208. So we're getting extended. So that's why I'm saying we're going to have a little bit of a pullback in the next 2 to 5 weeks, let's say, of anywhere from 100 to 250 points. But it's going to be it's going to be a buying opportunity. It's not going to be sell the rally and then every rally keep selling the rally kind of thing. It's going to be you want to buy the dip kind of mode. We've switched that off for the interim time frame. Okay, so that's a little bit about what I'm seeing on these charts right here on a longer term basis. Now, let me just switch over. Let's take a look at a couple of other charts here. So I'm going to flip the screen over here just real quick. Let me just come over here like this, and let's just see which one we want to look at here. All right, that one is. Let me just stop that real quick. And let me just see if I can get this screen up. I may not be able to get it up on the screen for you. If I can't get it up, that's okay. Let's see here. All right, it's not wanting to show over here, but let me see if I can just move it over here and get it like this. All right, and let me just see if that'll come up on the screen here. Here we go, right here. All right, so I had to move it over to screen number 4 to really get it up here. So let me get this screen up for you guys. Right here, I got to get all my screens situated. When you have this many screens, it's a pain in the tuchus. It's great to be able to look at stuff, but trying to coordinate this with WebEx is just a nightmare. So if we look at this, look at the Russell. Let's look at the Russell cash index. I mean, you can see this big, huge move up. Now, this chart right here, it is a weekly. So let's put it on the daily here. Let's just kind of take it out just a little bit. You can see that nice, steady progression, right? I mean, it's just a nice, steady progression higher. Nice channel up. Here is the closing price of 2019, 1668. We closed at 1507. We still have not made all-time high. The last all-time high in the rut was back in 2018 at 1742, but the rut has been moving very, very strong. And for our members, I've pointed our members in a really good way to play the Russell. It's a really great way because you can just scream up on this thing. Short-term trades, of course. Now, if we come over and look at NASDAQ's the only one in the green for the year. All right. Now, let me just find it on here. Look at the NASDAQ futures right here. Strong day on Friday, 181 points up. You can see here, I left it here on purpose. We've made new all-time highs. You can see the prior all-time high, we busted through it, right? Right here, and now we got new all-time highs right here. So that is just totally amazing to me. Understand what led us higher off these lows were these work-at-home companies, Slack and Zoom and Peloton, and you got Google, Amazon, Apple, Microsoft, a lot of these guys, cloud computing. These have just been really led the way. You can see on this daily chart the 50, now these are EMAs, the 50 EMA never went below the 200 on here on NASDAQ. And then away we go. We've got a nice spread in how this works, all right? Now, if I come over here and show you, I've got an index here. I just made an index of FANG. You can see the FANG has not made new all-time highs. The FANG has been running sideways. So I've got in this customized index, I've got Microsoft and Facebook, Apple, Netflix, Google, and Amazon, okay? And in this, you can see money really is what pushed this higher. But we made an all-time high here in this FANG index on May 21st. And then since then, money's been slowly coming out of here. And it's been going in other areas, travel and leisure, like the cruise lines, like the airlines, some of the casinos, some of the restaurants. I've been getting our members in some of this for the past couple of weeks and suggesting some of these trades, right? Because I could see this rotation. We've got another tool that's coming out that's going to allow you to help track some of this rotation for our group. And one of our members and I are working on constructing this thing. So it's really a pretty cool way to keep track of relative performance using the S&P as a benchmark guideline. Now, if we come over here and we look at, let me just get that off here. If we come over here and we look at volatility, and if we take volatility here and look at the VIX, okay, the high here of 85.47, and we hit that high back here. Let me just get this down here. So we hit that high right on March 18th, even though the lows were made on March 23rd. And then you can see vol has come down. We're now in the rose-colored zone right now, okay, right here. Vol actually fell this week. If we look at the volatility index, it fell about 10.8% from the prior week. We closed at 24.52 for the week, okay? And we're down a lot low. We're still elevated, but we're a lot lower than we have been. When we do get that 100 to 250 point dip, which is what I see coming in the next, again, anywhere from 2 to 5 weeks roughly in time, we're going to see vol move up quicker than normal, just because the scab is still very sensitive here with volatility and a big fear of selling off, okay? And there is also still a large amount of shorts in the market, but all we're going to do is just watch price action. It's going to give us a guide as to where vol wants to go. I'm going to use it as a buy the dip kind of opportunity once we get the signal to go back in again. And then, of course, if we look at treasuries, and let's look at the bond market, it was down over a full handle. Look at that break. I mean, boom, it broke. And it's just kind of slowly leading up to it. And then once it broke, we're coming down. Now, these are EMAs. But once we come down, we're probably going to test the 168 area, which means interest rates are going to go higher. And if we look at the 10-year interest rate, you can see the 10-year broke this level right here. So if I were to put this on the chart here, let's just come over here, and you can see that level there that we broke, right? We just broke out of that channel. Right in that area right here. So that channel, just put it right in there. There's the channel. We broke out of the channel. We're moving up. And as long as we can move up steadily, not like this was a panic situation during the crash. But if we can move up and just kind of chop around here, that would be a good thing. And the markets know the Feds have the back from a liquidity standpoint, so they're always willing to step in to kind of keep interest rates suppressed a little bit. But a little bit of growth is going to be a good thing. Okay. And then, of course, if we look at the currency market, you can look at the US dollar. It is just slowly coming down, right? We had a strong Friday because of economic data. But I think the dollar, as I told everybody, it's going to be shifting over time to more downside move. If we really zoom out, you can see the dollar has been moving up in this regression channel since the summer of 2018, right? And just don't pay attention to this. This was the March crash where everybody hoarded the dollar. All countries hoarded the dollar. The Feds had to come in and do a reverse repo to sell the dollar to get it back in alignment here. And then slowly the dollar's coming back down. I think it'll come back down to the 2019 closing area. So the dollar will be flat for the year. That would make sense to me. But it's going to still stay relatively elevated until we get through some of this nonsense here. Okay. Now, if we come over here and let's just look at gold. Gold confounds a lot of people. It fell almost 39 points on Friday. Notice we're still in this tight range here. I am bullish gold 2 or 3 years out in time. Near term, as I'm telling our members, I'm not. I'm sitting on the sidelines because I think gold, if it breaks this 1674 level, we're going to come down here to the 1600 level, test the 200. This is an EMA now, not an SMA. It's going to test this level here. And then at some point, gold's going to take off again. But now if you look at this chart, gold has been kind of in a sideways range going all the way back to April, early April. Gold hadn't gone anywhere. It's traded up and it's down in a range. But look at silver. This is silver futures. If we go back to early April here, right in this area here, silver's been on a rocket ship up. What I told our members is silver relative performance to gold is going to take off. And sure enough, it did. Last time we traded silver, we did the same thing. Because I think back here in early April, it's like 110 ounces of silver to 1 ounce of gold. And the 15-year average is like 60 ounces of silver. So it was almost way out of whack. So I said, if you're going to do any precious metal, do silver. And it was kind of like the unheard of metal, and it just took off. So bully to all of our members that took that trade. It just, now we're going to run sideways. There's going to be some profit taken in here as we move forward. Okay. Copper, it's another one that I was talking about, members getting long down in this area here, and away we went. It's a great trade for copper. There are ways to trade copper. For our members, I had us doing this. The nice thing about commodities now, guys, is if you pick the right ETF, you can play the commodity market, which should be a part of your portfolio, whether you're going to day trade it, swing trade it, or take some positions longer term. It should be a part of your portfolio because there's going to be some great commodity trades over the next 2 or 3 years. Okay. For our members, we're going to be just really locking in on some of these things. Let's look at oil. Well, oil is just like, forget about it, right? I mean, look at oil. I have the zero rate here completely etched on my chart, but we started trading oil down here to the upside, right? It was just too easy the low-hanging fruit to trade. And there's a certain way to trade oil that you've got to do. If you trade it the wrong way, you will get massacred. And some people have been massacred. Even now, there's a certain way and a right way to trade oil versus the wrong way. For our members, we'll go through this Sunday evening, but you've got to make sure you're trading it the right way. But there's still, I think, some more upside in oil, back up to the low 50s, mid 50s, which is where the more of a value area should sit for the oil markets. Okay, and if we look at nat gas here, another really good opportunity in nat gas for our members. I'll talk to you about how we can play this one as well. Okay, so from oil to nat gas. Now, we haven't traded gasoline futures or the ETF that tracks gasoline futures, but it's kind of running side by side with oil futures right now. All right, there's still a lot of inventory, but as people get back on the roads again and they start driving, you're going to see gasoline futures come up. Guys, these are low-hanging fruit trades, okay? And when you get down here, you got to take the trade. Then there's a number of different ways to do it, like I said, on ETFs without having to trade the futures market. Now, there's other things going in the ag market, meats, softs, and we've got some other things cooking here as far as stocks go. Members, I'll go through this with you for our Sunday night edition. If you're not a member, again, I highly encourage you to come in. You got to play. You want to be the red striped zebra. You do not want to come in here and play this market trying to do what everybody else is doing. You just don't want to do that, because if you do, you're going to be a sucker. And you're just going to follow everybody else, and what everybody else does, that's what you're going to do. And when you do that kind of thing, you're going to be left out, right? You are going to be left out of the game. You're not going to have the returns that you should have. You're not going to flow the way it should flow. So what you need to do here, right? What you need to do is be the red striped zebra. You want to stand out, which means a little bit of contrarian nature in your trade, because the crowd is always wrong. I can tell you over and over again on put call ratios, on market breadth, and on the independent asset managers, every time they're overly bullish or overly bearish, the markets go the other way. And you got to play the game that way. That's why so many retail traders get it wrong when they first start. They're with the crowd. And then with the crowd, they get whipped. All right, everybody, that's kind of where we are right now. I will see our members. I will see you guys this Sunday evening for our weekly market watch. Everybody else, have a really great weekend. Enjoy the weekend, and just take care, everybody. I'll see you later. Ciao now.